The following production is presented by League InfoSite and the Credit Union Broadcast Experience, QTV.
Hello, I'm Gloria Ledoux.
And I'm Sean Wolbert.
Bringing you the CU Compliance Connection by InfoSite, only on QTV.
One of the greatest things about the credit union community is that we join together to share information. Our collective knowledge and experience makes us stronger and better able to serve the needs of our members.
It does. We wanted to share some of the common questions and concerns we receive from credit unions. So this special feature will focus on questions we have answered from credit unions just like yours.
One of the most frequent questions I have gotten is on direct credit disputes. If a member disputes the credit union's credit reporting for their loan, the credit union must conduct a reasonable investigation with respect to the disputed information. Review all relevant information provided by the member in the dispute notice. Complete the investigation and report the results of the investigation to the member within 30 days of receipt of the dispute. And if the investigation finds that the information reported was inaccurate, the credit union has to promptly notify the consumer reporting agency that the credit union provided this inaccurate information to, provide them with the information necessary to make corrections so that they're correctly reporting on the members, and make sure that they communicate that with the member.
We also received numerous questions about Social Security representative payee accounts. One of the most common questions is related to loans. A loan is being requested for the beneficiary, and the Social Security benefits are to be used as the income. There are really great resources on the Social Security website, so we encourage people to check that out. But it does contain the answer to this question. The beneficiary does not have access to the money in the representative payee account. Additionally, the rep payee doesn't have any requirements to make the payments, and even if they agree, a new rep payee could be assigned at any time. Since the money in the rep payee account is used for the beneficiary's day-to-day needs for food and shelter, medical and dental care not covered by insurance, and for personal needs such as clothing and recreation, any money that is left over must be saved. So essentially, money from the SSA, or the Social Security Administration, cannot be used for consideration when underwriting the loan. If the beneficiary has other income, that can be used.
I want to talk about one of the most recent confusing CFPB changes that affects Secure and Fair Enforcement for Mortgage Licensing Act, or the SAFE Act. And this deals with the unique identifier issue. Gloria, I can't tell you how many times I've gotten questions about this from credit unions. And when I talk about it as I do speeches, people say, wait a minute, what do you mean we have to have two identifiers on our documentation? Well, that's one of the new requirements. Recent changes require the credit union to make the credit union's unique identifier and credit union name, in addition to the unique identifier of their mortgage loan originators, available to members in a manner and method that's practicable to the credit union. Previous SAFE Act requirements only pertained to the mortgage loan originator's unique ID. So, in addition to the credit union's information, the new requirement that it's not been widely talked about, and it's something that they need to have and do, and they need to do it quickly.
Right, and there is a requirement for that to be on the mortgage documents that the member signs.
Yep.
Okay, so I'm going to stick with our rep payee account topic because these are questions that we really receive frequently, and it's what to do with the account after the beneficiary dies. So if that happens, the rep payee must notify the Social Security Administration. Any funds remaining in the account belong to the beneficiary's estate. The SSI checks received after the month of death must be returned. Therefore, credit unions are advised to freeze the funds and have the representative payee contact the probate court for guidance. The credit union should then wait to receive fund direction from the executor of the estate before they disperse those funds.
And I know that a lot of times when credit unions haven't followed these guidelines, and the money has been reclaimed by the Social Security Administration. Those payments get reclaimed.
Yes, they do.
They come right out of the credit union's Fed account. You can't stop the Social Security Administration from taking the funds. So if you've allowed someone on the estate or allowed someone to take the funds,
Right.
the federal government is going to take those funds whether they're in the account or not.
Yes.
And then the credit union really loses.
Right.
An interesting suspicious activity question that has been posed by several credit unions relates to being able to close a member's account after they file a SAR. Now you'd think with this, you're filing suspicious activity. You're questioning whether this member has something going on that could be illegal at times. But the guidance, according to the NCUA's Examiner Guide, it states that the credit union cannot close an account or even restrict services based solely on a SAR filing. The Examiner's Guide states that since a credit union member has a fundamental right to maintain a share account and participate in elections, the credit union cannot deny someone the membership because it has identified suspicious activity. However, the credit union may wish to consider limiting access to certain services. To do that, the credit union must have established its policy in writing and notified its members of that policy in advance. So it's not on a one-on-one basis. It has to be a policy and you have to apply it to all members equally. The credit union should not consider the mere filing of a SAR as the basis for limiting services. It's important to note that the credit union may not, by law, notify any person involved in an activity that's being reported on a SAR, and that the credit union has reported that activity or that it has filed the SAR on the member. It's got to be kept confidential.
Absolutely. And there's been some litigation on that as well, of people that have disclosed the existence of a SAR.
And have had jail time in regards to that.
That's right. So we've had a few questions, especially around tax time, about providing credit card cash advances on cards without a name embossed on the front. So first we want to say that we encourage credit unions to review their MasterCard and/or Visa rules and agreements. From what we understand, your agreement may stipulate that you are actually required to provide these services as a Visa MasterCard client. And that's provided that your credit union allows for cash advances and, generally and in the first place. Again, from what we have read, as long as the back of the card is signed and your member is providing proper identification to accompany the card and you're matching the signatures, the credit union would be protected from the fraud chargebacks. So really, when someone comes in with no name embossed on the front, you got to flip it over, make sure the signature is in place, obtain proper identification, and you should be able to proceed with that cash advance.
And that makes sense.
Yeah.
In my travels, I've noticed a lot of interesting and progressive credit union advertisements. And I've got to say, some of the things I'm seeing now are really amazing advertisements.
Yeah.
They make me want to join. But it's very important that when you're placing these advertisements, that you meet the regulatory advertising requirements. Make sure that the credit union's advertisements include the NCUA official sign or advertising statement as required. Also, if you're advertising loans, research the requirements for disclosures if trigger terms are going to be used in those advertisements, because there are specific things you have to include if you use a trigger term in a loan ad. Finally, there's so much new scrutiny on UDAP and really unfair and deceptive practices acts, whether or not your advertisements are really advertising what they should be,
Right.
if you're being honest in those advertisements. So really make sure that the credit union's advertisements are accurate.
And coming from a compliance officer, we always say, that's not a bad thing if you over-disclose.
Very true, especially in advertising.
Yeah. Which is why those disclosure paragraphs end up being this long at the bottom. And the ads only this long. So now I'm going to move on. Sean, why do members want to stop payments on cashier's checks?
I have to be honest with you. When we first started talking about this and adding it as a question to the segment, credit unions do this, and I think they do this because they're not really considering the liability to the credit union or the risk that the credit union is taking, and they don't have knowledge about the laws that apply to these cashier's checks.
Well, that's what we're going to discuss. So the UCC considers a cashier's check and traveler's check cash. So if the credit union refuses to pay a cashier's check, it may be liable for compensation and lost interest and consequential damages in addition to the amount of the check. So this would include situations where the credit union wrongfully stopped payment. In the event of a lost, stolen, or destroyed cashier's check, the member can sign a declaration of loss and asset and assert a claim, which becomes enforceable, but that's no earlier than 90 days from the date of the cashier's check. After that 90 days, the credit union can refund the credit union member, stopping payment, and can refuse the original if it ever shows up. So credit unions who stop payments prior to that 90 days, they run the risk of having to pay out both cashier's checks if both are actually presented. They'll be obligated to pay both. So credit unions, in consultation with an attorney, could explore indemnification agreements and indemnity bonds. However, this really has to be a risk-based assessment and a decision conducted by senior management of the credit union.
Yep, and I think, one of the scariest things about this is case law continually in our history has upheld the UCC and said, I'm sorry, but a cashier's check is cash.
Right.
You have two valid cashier's checks, you have to pay them both out.
That's right.
So credit unions really need to understand that if you're issuing a stop payment on a cashier's check before that 90 days and you're not getting the indemnification at the 90-day point and further into the future, the risk of having to pay both checks is, honestly, it's out there.
Right.
And the loss to the credit union, if it's a purchase of a $36,000 vehicle, or if it's going to go towards the purchase of a house and it's $150,000, that really could impact a
Yes.
credit union's net assets.
Yes, it could.
Thank you for joining Gloria and I at the CU Compliance Connection. And we just want to say we want to address the issues that you have. If you have a question, something about compliance that's been nagging at you, or you just want to get your question answered on this show, feel free to email it to us, and Gloria and I will do our best to find the answer that's right for you. So stay tuned for future broadcasts on issues that affect your credit union.
We're here to help you at the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.